The room is quiet except for the low hum of ventilation. A man in a dark suit leans forward, not hurried, not dramatic, just precise. His fingers hover over the keyboard for a moment, then press. Click. Somewhere numbers shift. Not small numbers. Not the kind you count. The kind you inherit. The kind you never actually see. On another screen, a chart flickers. A line bends upward, then steadies, then rises again, as if nothing in the world could stop it. Outside traffic moves. People buy coffee. Someone checks their phone and pays with a tap. No cash, no pause. Just a silent confirmation. Approved. But behind that simple transaction, something older is moving. A promise, a claim, an obligation that didn't exist a second ago. Now it does. And it will stay long after the coffee is gone. Here's the part that doesn't sit right. Every country on earth is in debt. Not some, all. Trillions stacked on trillions. The United States alone, over $38 trillion. Europe, Japan, even nations built on oil, exports, or surplus. All of them owe. So, stop for a second. If everyone owes, who exactly is getting paid? Because someone must be, or at least, that's what we're supposed to believe. And if no one is, then what exactly is holding this entire system together? The numbers don't hide, they sit there, public, repeated, almost normalized. Global debt has crossed $300 trillion, roughly 3 times the size of the entire world economy. Governments borrow, corporations borrow, households borrow. The system doesn't slow, it compounds. Look closer. The United States issues treasury bonds. Pension funds buy them. Banks hold them. The Federal Reserve buys them too, sometimes with money it creates on the spot. Across the Atlantic, the European Central Bank does the same. Japan has been doing it longer, larger, quieter. Money moves, then returns, then moves again. A loop. You pay taxes. Part of that money services interest on government debt. That interest flows into funds, retirement accounts, insurance pools, institutional portfolios. Many of those funds belong to people like you, or will eventually. So the system starts to blur. Debtor, creditor. The line isn't clean anymore. Go wider. Countries hold each other's debt. Japan holds U.S. bonds. The U.S. influences global lending through institutions like the International Monetary Fund and the World Bank. Developing economies accumulate reserves, often stored back into Western financial assets. Capital circles the globe. Not randomly, repeatedly. It begins to resemble something else. Not a hierarchy, not a simple chain. A network of promises, each one backed by another. Each one depending on the next to remain credible. And here's where it becomes uncomfortable. Because this system doesn't require debt to disappear, it requires it to continue. Not resolved, not eliminated, maintained. Rolled forward, extended just enough that no one asks what happens, if it ever stops. The system doesn't look like a pyramid when you stand inside it. It feels flat, normal, routine. You earn, you spend, you save. Somewhere in the background, debt expands, quietly. But step back far enough, and patterns begin to show. Not one mechanism, several, interlocked, reinforcing each other. Let's break it apart. 1. Sovereign debt, power borrowed from the future. London, late 17th century. A table covered in ledgers, ink still wet. The crown is out of gold. War doesn't pause for shortages. Soldiers still need to be paid. Merchants sit across from the state. They don't offer charity, they offer terms. Interest backed by future taxes. A signature, then another. The structure that follows becomes the Bank of England. Not just a bank, a shift in power. The state no longer needs gold in hand. It needs credibility. That's the pivot. Before this, empires extracted wealth. After this, they borrowed it. And borrowing changed everything. A government bond is simple on paper. The state promises to pay interest over time and return the principal later. But in practice, something else happens. The bond becomes tradable. It moves from one balance sheet to another, from a bank to a pension fund, from a domestic investor to a foreign central bank. And here's the mechanism that matters. Governments rarely pay the principal back. They refinance. Old debt is replaced with new debt, continuously. 'Cause right arrow. The state spends beyond current revenue effect right arrow. It issues bonds mechanism. Right arrow, new bonds pay off old ones. The system doesn't aim for zero. It aims for continuity. As long as investors believe the government can service interest, Keep the payments flowing, the system holds. Lose that belief. Yields spike, borrowing costs surge, the loop tightens. We've seen it before. 2. Domestic ownership in the illusion of external debt. A treasury auction closes, orders filled, quiet. No headlines. Most of the buyers aren't foreign governments. They're domestic institutions. Banks, insurance companies, pension funds. Inside the United States, a large portion of federal debt is held internally. That means interest payments don't leave the country, they circulate. You pay taxes. That money services debt. The interest flows into a fund. That fund holds government bonds. That fund supports retirement accounts. A closed circuit, but not a neutral one, because ownership isn't evenly distributed. Some people hold assets. Others hold liabilities. Some receive interest. Others finance it. Same system, different position. The mechanics look stable because they are circular. But circular doesn't mean equal. It means contained. 3. Global interdependence. Nations holding each other hostage. A bond issued in Washington can end up on a balance sheet in Tokyo. Japan accumulates reserves. It needs somewhere stable to store them. U.S. treasuries become the default. China does the same at scale. Europe channels capital through financial hubs. Smaller economies park reserves in larger ones. Money crosses borders, then anchors itself in another country's debt. This creates a web, not bilateral, multilateral. Country A holds country B's bonds. Country B holds country C's. Country C invests back into A. No single point of control, but also no easy exit. If one major player sells aggressively, markets react. Prices fall, yields rise. Balance sheets weaken globally. So they don't. Not because they can't, because the cost is too high. This is where debt becomes leverage. Not military, financial. Silent, continuous. Each country depends on the stability of others, not out of trust, but necessity. 4. Financial institutions, the invisible middle layer. Walk into a trading floor. Screens stacked. Numbers updating faster than eyes can follow. Orders flash, disappear, reappear. Between governments and citizens sits a dense layer of institutions. Hedge funds, asset managers, sovereign wealth funds, insurance firms. They don't issue currency. They don't collect taxes, but they decide pricing. They decide demand. They decide risk. When confidence is high, they absorb debt easily. Yields stay low. Governments borrow cheaply. When confidence cracks, they step back. Suddenly, the same bond requires higher returns. Governments must offer more interest to attract buyers. Costs rise, budgets strain. The mechanism is simple. Cause leads to perceived risk increases. Effect leads to investors demand higher yield. Mechanism leads to borrowing becomes more expensive. And this feedback loop can accelerate quickly. We saw it during the European debt crisis. 5. Central banks creating the backbone of the system. A policy meeting ends. No noise, no spectacle. Then the announcement. Asset purchases. Behind that phrase is something more direct. Money creation. When a central bank like the Federal Reserve or the European Central Bank buys government bonds, it doesn't transfer existing money. It creates new reserves. Digital, instant. Those reserves enter the banking system. Liquidity expands. The government gets financing. Markets stabilize. But the structure changes because every unit of currency created corresponds to a liability somewhere else. Money and debt become inseparable. No debt leads to no money expansion. This is the core reality. Modern money is debt-based. Not metaphorically, mechanically. And once the system depends on expansion, contraction becomes dangerous. Less borrowing leads to less liquidity. Less liquidity leads to tighter conditions. Tighter conditions leads to stress across markets. So central banks intervene, not occasionally, repeatedly. 6. Crisis points. When the system breaks visibility. Athens, 2010. Shops closed. Protests filling the streets. Tear gas hanging in the air. Government bonds are no longer trusted. Investors pull back. Yields spike. The country can't refinance at sustainable rates. External institutions step in. The International Monetary Fund. European authorities. They provide loans, but not freely. Conditions follow. Spending cuts, tax increases, structural reforms. The burden shifts from markets to citizens. In Argentina, this pattern repeats across decades. Default, restructure, return, repeat. In Sri Lanka, shortages escalate into political collapse. Different regions, same mechanism. When confidence breaks, the loop doesn't disappear. It tightens. And the creditors, once abstract, become visible. 7. The core mechanism. debt that never ends. At the center of all this is a simple but uncomfortable truth. Debt is not designed to be fully repaid. It is designed to be sustained. Governments roll over obligations, issue new bonds, service interest. The principle remains, year after year, decade after decade. Cause arrow continuous borrowing effect, arrow expanding debt stock, mechanism arrow refinancing replaces repayment. Investors don't expect closure. They expect continuity. Because those bonds are not just liabilities. They are assets, collateral, benchmarks, foundations of portfolios. Remove them and the system loses its anchor. So the system persists, not because it resolves debt, because it cannot function without it. Step back. Different countries, different headlines, same pattern. Japan first. Debt levels exceed 250% of GDP, a number that would trigger panic anywhere else. Yet yields remain near zero. The reason isn't mystery, it's structure. Most of Japan's debt is held domestically. Institutions buy. The central bank supports. The loop stays internal. Now shift to the United States. Lower debt to GDP than Japan, but far more globalized. U.S. Treasuries sit at the center of international finance. Foreign governments, banks, and funds hold them as reserves. The dollar system extends far beyond its borders. Different scale, different exposure than Europe. Multiple countries sharing one currency, one central bank, the European Central Bank, but many fiscal policies. When weaker economies accumulate too much debt, the tension spreads across the entire system. Greece wasn't isolated, it was structural. Now compare that to emerging markets. Countries like Argentina borrow in foreign currencies. That's the key difference. When their own currency weakens, their debt burden effectively grows. Servicing it becomes harder. Confidence breaks faster. Same concept, different fragility. Across all these cases, one pattern repeats. If debt is internal, then stability increases. If debt is external, then vulnerability increases. If a central bank can intervene, then time is extended. If it cannot, then crisis accelerates. Different countries, same architecture. The rules don't change. Only the margin of error does. The system doesn't collapse all at once. It shifts, gradually, then suddenly. So what do you actually take from this? Start with position. You are not outside the system. You are inside it. Every paycheck, every tax payment, every savings account, it all connects back to the same structure of debt and assets. So the first principle is simple. Know which side you're on. Are you holding assets that benefit from the system continuing? Or are you only exposed to its obligations? Because when stress appears, the gap widens. Second, liquidity matters more than optimism. In stable periods, everything looks safe. Credit expands. Prices rise, risk feels distant. But when confidence tightens, liquidity disappears first. Not value, access. Assets you thought you could sell, stall. Cash, real, accessible liquidity becomes leverage. Third, diversification is not optional. Not just across assets, across systems. Domestic exposure alone ties you to one policy framework, one currency, one central bank decision. Broader exposure, geographic, monetary, institutional, reduces that dependency. Not eliminates it, reduces it. Fourth, watch the signals, not the headlines. Debt levels alone don't trigger collapse, confidence does. Rising yields, currency pressure, sudden policy shifts. These are early signals of stress inside the system. They appear before the narrative changes. And finally, understand this clearly. The system is designed to continue, not to resolve itself. So the goal isn't to predict an ending. It's to remain stable, while everything else adjusts around you. The screen refreshes again. Numbers update. Quietly, no alarm, no signal that anything is wrong. And yet, everything depends on those numbers continuing to move the way they always have. Forward. We started with a simple question. If everyone owes, who gets paid? The answer never really changed. We do, and we don't. The system holds because we keep believing it will. Governments roll the debt. Markets price it. Institutions absorb it. People live inside it. A loop stable until it isn't. So don't look for the moment it ends. Watch the moments it strains. Because debt was never just a number. It was always a promise. And the only thing holding it together is trust.